If you're 30,000 feet up, flying over the American Midwest, the Earth is just dotted with these massive, perfectly engineered green circles.
Right. Yeah.
And from the sky, those irrigated fields look, absolutely flawless. It's like someone took a giant geometer's compass to the dirt and just drew these precise, predictable shapes across the plains.
Yeah, it's a really striking visual.
But if you zoom in closer, past the crops, past the topsoil, straight into the balance sheets of the companies building the machinery that actually draws those circles, you find this machine just grinding violently against macroeconomics.
You really do. I mean, we're basically looking at a textbook example of how this surface-level agricultural calm hides some intense underlying volatility in the industrial supply chain.
Exactly. So welcome to today's deep dive. We are digging into the Q2 2026 earnings report from Lindsay Corporation. That's ticker symbol LNN, which just dropped on April 2, 2026.
And we've got a solid stack of sources for this one.
Yeah, we're using their earnings call transcript, the slide deck presentation, and the official press release. And if you're listening today, your mission for this deep dive is basically a masterclass in seeing the forest through the trees.
Right.
Because, Lindsay, they manufacture those massive agricultural irrigation systems like the Zematic Center pivots, and they also have an infrastructure division building highway safety equipment like the Road Zipper.
Which is fascinating tech on its own, but yeah.
But looking at their earnings, it isn't just about farm equipment or highway barriers. It is a perfect lens for you to understand some really massive global megatrends.
Oh, absolutely.
We are going to unpack how macro-level shocks from Middle Eastern geopolitics and Brazilian interest rates to, U.S. agricultural policy ripple all the way down to the dirt and the asphalt.
Yeah, and to set the baseline here, this was a really punishing quarter for them. I mean, the headline numbers reflect a pretty severe contraction.
Yeah, it was rough.
Total Q2 revenue fell 16% year over year. So they landed at $157.7 million. Operating margins were just slashed in half, down to 8.3%.
Wow, half.
Yeah. And earnings per share came in at $1.15, which completely missed the consensus estimate of $1.60.
So Lindsay is just bleeding margin right now. But to understand why, we really have to start with the psychology and, frankly, the wallet of their core customer.
The North American farmer.
Right. Who is currently playing a very serious game of wait and see. North American irrigation revenue dropped 8%, down to $71 million.
Which is a huge hit.
And demand is soft because of low commodity prices and just generally tempered farmer sentiment. The USDA is projecting 2026 U.S. net farm income to decrease to $153.4 billion.
Right, and when commodity prices are low and projected income shrinks like that, a farmer's capital expenditure just freezes. It stops.
They just lock up the checkbook.
Exactly, because a new center pivot irrigation system, that is a massive, six-figure investment. It's definitely not an impulse purchase.
No, you're not just picking one up at the hardware store.
Right. So when crop futures look weak, a grower is going to patch up a leaking 30-year-old pivot with duct tape and spare parts rather than go sign a loan for a brand new system. They enter pure capital preservation mode.
And the market right now is basically waiting on the injection of government capital to unfreeze that spending.
Yep.
The sources detail a couple things here. First, there's the $12 billion Farm Bridge Assistance Program, which begins its payouts in the first quarter of 2026.
Right.
And there is also the One Big Beautiful Bill Act, which was signed into law on July 4, 2025. And just as a quick note for you listening, we're impartially reporting these government programs exactly as they appear in the sources. We aren't taking any political stance here, just conveying the facts of the legislation that's impacting this specific market.
Exactly. We're just looking at the dollars and cents.
Right.
And that specific act extended accelerated depreciation for equipment purchases. Those federal dollars fundamentally changed the return on investment math for the grower. Accelerated depreciation lets a farmer write off the cost of the equipment faster, which lowers their immediate tax burden.
But the issue is that money hasn't fully circulated through the equipment market yet.
No, it hasn't.
Which leaves Lindsay in this really bizarre financial paradox this quarter, because despite lower unit sales, they actually raised their average selling prices for their equipment.
They did, yeah.
But somehow their irrigation operating margins still compressed from 18.5% down to 13.8%. And I really need to push back on the mechanics of that.
Go for it.
If a company possesses the pricing power to charge more per unit, shouldn't their margins expand or at least hold steady? I mean, think about renting a massive, expensive stadium to throw a concert, but you only sell 10 tickets.
Right.
The overhead eats you alive regardless of what you charge for those 10 tickets. Is that basically what's happening in their Nebraska factory?
That is a perfect analogy. You are describing the brutal reality of what we call fixed cost deleverage.
Fixed cost deleverage. Okay.
Yeah. When you operate heavy industrial facilities, a massive percentage of your overhead is fixed. The property taxes, the depreciation of the heavy machinery, the core operational staff.
The heating bills for the furnaces.
Exactly. Those bills are due whether you manufacture 10 irrigation pivots or 10,000. So when the overall volume of orders drops by 8%, you are spreading those massive fixed costs over a much smaller number of units.
So the per unit cost to build the equipment just skyrockets.
It skyrockets.
Yeah.
So even though Lindsay pushed through a price increase to the end consumer, it wasn't nearly enough to offset the sheer weight of running a half-empty factory. It's a classic margin squeeze.
Wow. Okay, that makes sense internally. But externally, they're also fighting a ground war for market share, right?
Absolutely.
The earnings call noted intense competition from smaller, privately held family businesses in the irrigation space trying to aggressively win market share. Why is a regional, family-owned manufacturer able to slash prices when a publicly traded giant like Lindsay can't?
Well, it comes down to incentives. A local owner-operator plays by a completely different set of financial rules during an agricultural trough.
How so?
A publicly traded company like Lindsay has to answer to Wall Street. They have strict margin requirements, quarterly earnings targets. If the profit margin is too thin, they literally have to walk away from a sale.
They can't justify it to the shareholders.
Right. But a third-generation family business? They might have zero debt on their facility. Their primary goal during a downturn isn't to maximize quarterly yield.
It's survival.
Exactly. It's just generating enough cash flow to keep the lights on and prevent their highly skilled welders from leaving for another job. So they will happily sell equipment at cost just to keep the factory humming.
So Lindsay is basically holding the line on strategic pricing, bleeding short-term margin just to maintain their brand premium?
Yeah, that's exactly what they're doing.
But that domestic pricing discipline is really only half the story. Because the same inflationary pressures that are paralyzing the American farmer are acting entirely differently overseas.
Yeah, the international picture is wild right now.
Let's shift to the international ripple effects. International irrigation revenue was relatively flat. It was down just 1% to $70.2 million.
Which doesn't sound too bad on the surface.
Right. But beneath that flat headline, there is this fascinating divergence between Brazil and the Middle East North Africa region, or MENA.
Yeah, the Brazilian market is a perfect case study in how government policy and the cost of capital dictate physical agriculture.
Sales volume there is just down, right?
Completely down.
Yeah.
Because Brazilian growers are frozen by incredibly high interest rates and credit constraints. They are sidelined, waiting for the government's 2026 crop plan to drop in July.
Okay.
Because when that drops, the benchmark rate is expected to drive equipment financing costs way below last year's 12.5%.
So it's basically like a consumer waiting for Black Friday. I mean, why would you buy a massive tractor today if you know the government might significantly subsidize your loan in July?
You wouldn't. The math for a Brazilian grower right now is just ruthless. If you borrow $1 million at 12.5% today, the debt service completely eats your crop yield.
Right.
But if you just delay your purchase by 3 months and secure a subsidized loan at, say, 9%, the lifetime return on that equipment transforms. So they aren't going to buy a single piece of steel until that July crop plan is published.
So Brazil is effectively paused, but then we look at MENA.
Yeah.
Lindsay is delivering a massive $80 million irrigation project in the Middle East right now. And management claimed on the call that the project is on schedule with fully intact supply chains, despite the ongoing Middle East conflict.
That was definitely a headline grabber from the call.
I have to pause and push back on that. How on earth is a logistics-heavy $80 million deployment of heavy steel and electronics proceeding normally right in the middle of a conflict zone? I mean, you have to move raw materials through the Red Sea, the Strait of Hormuz.
It sounds impossible, right? And management actually addressed that exact skepticism. They specifically contrasted this current MENA dynamic with the massive supply chain shock we saw during the 2022 Russia-Ukraine conflict.
Okay, what's the difference?
The foundational difference is that Iran is not a major exporter of grain to the global market.
Oh, interesting.
Yeah, so it isolates the agricultural commodity disruption.
Oh, wait, grain is the output. I'm looking at the inputs. How are they dodging the freight premiums and the shipping blockades to actually build the equipment over there?
Well, that's the nuance of their global supply chains.
Yeah.
Their stability is predicated on localized sourcing where possible, and honestly, a very specific chronological gamble.
A gamble.
Yes. Management was very explicit that their models assume this disruption is short. They are talking weeks, not quarters.
Oh, wow.
They are relying on existing inventory buffers already positioned within the region. If the conflict protracts, those buffers evaporate. And the moment maritime insurance premiums spike for new freight, that $80 million backlog becomes a massive margin liability.
So it's a ticking clock.
Exactly.
Man. Well, since agriculture is highly cyclical and clearly stuck in a trough right now, Lindsay's infrastructure segment is supposed to be their counterweight, right?
That's the theory, yeah.
When farmers stop buying pivots, state governments are supposed to be buying highway barriers. But looking at the Q2 headline numbers, it seems like the bottom fell out there too.
It looks pretty grim on paper.
Yeah, infrastructure revenues plummeted 58%, down to $16.5 million. And operating income dropped 91%.
Which looks like a total structural collapse.
It does, until you dig into the accounting. We need to introduce this concept of a statistical ghost.
I love this part.
In Q2 of 2025, Lindsay delivered a massive one-time $20 million road zipper project. And for those who don't know, a road zipper is this massive, highly specialized vehicle that basically drives over concrete highway barriers, lifts them up internally, and shifts them one lane over while driving 10 miles an hour.
It's wild to watch.
It's incredible. But the key here is that it's highly specialized capital equipment. It is not a recurring purchase.
Right. When a municipality drops $20 million on a road zipper system, they don't buy another one the very next year.
Exactly. So that single massive project artificially inflated last year's Q2 revenue. And now, a year later, Lindsay is lapping that anomaly.
So the absence of that $20 million project is basically a ghost haunting this quarter's spreadsheet. It creates the illusion of a 58% collapse.
Right, making the current reality look way worse than it actually is. Because if you exclude that massive prior year project, infrastructure revenue actually grew 6%.
Exactly.
And that growth is driven by the road safety products. They have two new launches, the AlphaGuard barrier system and the Roadrunner truck-mounted attenuator.
Which are crucial safety components for road work.
Yeah, and the macro tailwinds for these products should be massive right now. The Infrastructure Investment and Jobs Act, the IIJA, includes $110 billion in incremental funding, and 85% of those funds are already committed to states, which has pushed state and local contract awards up 8 to 12% year to date.
So there's a lot of money sloshing around.
Right. But here's my pointed question. With $110 billion in government infrastructure money floating around and contract awards up double digits, why isn't Lindsay's organic growth even higher than 6%? Is inflation eating the profits?
You nailed it.
Yeah.
It's exactly that. You have to look at how these state departments of transportation actually approve projects.
Okay, how does that work?
They approve projects in nominal dollars, not physical volume. So let's say a state allocates $100 million to widen a 10-mile stretch of highway.
Okay.
Between the time that money is committed and the time the contract is actually executed, inflation hits. The cost of labor skyrockets. The cost of raw materials like steel and cement spikes.
So that $100 million doesn't buy 10 miles of highway anymore.
Exactly. It may be by 6 miles. The inflation fundamentally erodes the purchasing power of that IIJA funding. So the states are still spending the same amount of money, but they are building significantly less physical infrastructure. And for a supplier like Lindsay, that means the actual unit volume of AlphaGuard barriers or attenuators they sell is being dragged down by that inflation anchor.
That is brutal. So they are caught between an agricultural trough and infrastructure inflation. How does a business actually behave when they are squeezed like that?
Well, they look inward. They start spending cash to basically automate their future.
Yeah, let's talk about their capital allocation. Lindsay remains highly liquid. They have $236.1 million in available liquidity, and $186.1 million of that is straight cash.
That's a serious war chest.
It is. And they have no near-term debt maturities until 2030. Plus, they just returned $25.2 million to shareholders via share repurchases this quarter.
They are very well capitalized.
But they are aggressively spending it on capital expenditures. A new automated tube mill in Nebraska is now in full production, and a new galvanizing facility is on track for early fiscal 2027.
Right. And the strategic goal of these investments is to drastically reduce their reliance on variable labor.
Because right now, when the market violently swings up, they have to scramble to hire 100 people. And when it swings down, they have to fire them.
Exactly. That hire and fire cycle is incredibly expensive and disruptive. This new automated tube mill basically takes flat-rolled steel, forms it, and laser welds it continuously. It trades variable human labor costs for fixed capital costs.
Okay, but I have to push back on the timing of this.
Sure.
Isn't spending heavily on automated factories hurting their bottom line right now during a massive revenue slump? I mean, it feels like buying a massive, highly expensive tractor when you only have a small backyard garden.
That is a great way to put it, and you're not wrong. And management actually admitted this on the call.
Really? What did they say?
They acknowledged that currently, the efficiency gains from that new tube mill are being completely eaten up by the incremental depreciation costs of the investment.
Oh, wow. So another depreciation ghost.
Exactly. They built a machine designed to operate at peak volume, but they are running it in the trough. They absolutely need market volume to recover before these investments actually start generating incremental margin returns.
Wow. So they're just absorbing the pain now. Let's bring this all together for everyone listening.
It's a lot to process.
It is. But Lindsay is really offering a masterclass in surviving a cyclical trough.
Absolutely.
They are holding the line on strategic pricing. They are surviving on massive international backlogs like the Mine project, just hoping the conflict stays short.
Yep.
They're ignoring the statistical ghosts on their infrastructure balance sheet. And they are spending millions to automate their factories so they are leaner when the inevitable upswing occurs.
It's all about positioning for the eventual recovery.
Right. But I want to leave you listening with a final provocative thought to ponder based on a timeline that's sort of hidden in these sources.
Ooh, the macro cliff.
Exactly. We discussed the massive $110 billion IIJA infrastructure funding that is propping up these state budgets. That funding expires in September 2026.
Right.
And the key commodity support programs under the Farm Bill, those originally expired in September 2025 and were only temporarily extended.
Which is a terrifying convergence.
It is. So what happens to cyclical companies like Lindsay and honestly the broader global supply chain when these massive multi-billion-dollar government crutches potentially expire at the exact same time just a few quarters from now?
It could be a perfect storm.
It really could, because when you fly over the Midwest and look down at those perfectly circular green fields, they look permanent. But beneath the surface, it takes a relentless grind of automated machinery, global supply chain gambles, and massive legislative subsidies just to keep that circle perfectly green.